In this video, I'm going to share with you the reversal pattern of a double top and a double bottom. Double tops and double bottoms are great reversal patterns. They're essentially pictures or formations that appear on an FX, stock or commodity chart, and they're used for their predictive value because they give an indication of where future price may head. In this video, I will explain to you how to recognize double tops, double bottoms, when to use them, when to avoid them, as well as some real-world examples. I hope you find this video helpful.
In this video, I'm going to show to you how to recognize a double top pattern, explain when it's best to use them, when to avoid them, and then followed by a real-world example on the Euro-US dollar pair. So the first thing to recognize with a double top pattern is to understand that it's primarily a reversal pattern. So what you're looking for is you're looking for an example when price has been moving in one direction and then forms a double top as a precursor to a reversal. So you can see here's an example of a double top. You see that the pattern has two peaks, the peak A and peak C, and then one trough. This forms the basis of that double top, this pattern. Top 1 at A, a trough at B, top 2 at C. These 2 points, A and C, need to be approximately the same level. Now, what you're looking for in a double top or a double bottom, a reversal pattern, is the pattern is triggered when the trough at B is broken. So you simply draw a support line through the bottom of the trough at point B, and then when that line breaks, and on a candlestick chart you're looking for a break and close beneath that level, that's an indication that the pattern is live, it's in play if you like, and that it's not uncommon to have a retest of that broken point at B. So that is a very simple explanation for the double top. Now, the double bottom is exactly the same, but in reverse. You're looking for two troughs and one high point, and those two troughs need to be at approximately the same level, and it's the break here of this point which makes the pattern live. Now, in terms of targets, you're looking for the height of the pattern. So you're looking at the height from this line at A to C down to the line at B. That point symbolized by that arrow, that height is your target. That's what you can reasonably expect to have as your target. Similarly, on the double bottom, you're looking for the height of the pattern to be your target. So that's basically what a double top and a double bottom look like. But the key thing to remember is that they're reversal patterns. So you can see in the double top, you want to see a little bit of movement upwards before reversal down. And in a double bottom, you want to see a move down before some consolidation and a move up. You can see this is making sense because buyers are coming back into this bearish market thinking we don't want to allow the price to go any further lower and value has been hit. So it gives a good indication of the balance between buyers and sellers. And also note the trend line, which can be a helpful tool just to give you a helpful heads up whether that double top or double bottom pattern is looking more likely to coming into play. So first of all, when to use them? Well, the very best time to use these technical patterns is when you have fundamental reasons for a reversal. So you want to have some fundamental reason which makes you think price is going to reverse. After all, you can see price has obviously been moving higher here, so you have to have a fundamental reason to think why this bull trend has come to an end. It could be a number of reasons. It could be a central bank decision. It could be some fiscal stimulus. It could be even the fact that the market is heavily oversold or it's just due a correction. Any of those reasons are valid. But that's when you want to use them, when you have a fundamental reason to combine with the technicals. When to avoid them is when you're just simply trading the pattern. When you just scan through the charts and you just see the pattern, and just because the pattern's there, you try to take the trade and ignore the fundamental of that particular market. That's when you want to avoid using these technical patterns, because they work best when there's fundamental reasons for the trade alongside the technical reasons. Why choose between fundamental analysis and technical analysis when you can have both, and you can take the best of both of those forms of analysis to further increase the odds and the probabilities of your trading? So combining the fundamentals and the technicals together gives you a good guide about when to use them. So let's now look at a real market example. Well, at the time of making this video, August the 14th, what we can see is that the euro has some very overstretched long positions. There's been some record levels of euro longs in the market, and the upside surprises for the Eurozone data has kind of tailed off compared to the US. The US has seen some more positive data as of late, and the US jobless claims yesterday came in beneath 1 million for the first time since the COVID-19 crisis began. So there's a little bit more of a narrowing between the outlooks for the Eurozone and the US. And furthermore, we're seeing sort of US cases drop off in COVID-19 and European cases starting to rise. So that big gap that there was between European cases and US cases has started to narrow. Also, the real rate differentials between the US and Germany that triggered the euro-US dollar upside has stalled around the 30 basis point level, and we're seeing a little bit of flattening in that previous divergence. So these are the fundamentals that make a correction lower in the euro-US dollar would make sense from a fundamental perspective. So we have our fundamental bias for the euro-US dollar pair. Now, of course, that doesn't mean the trade will definitely work out, but it does mean that we have a fundamental reason for it. Now, if we take a look at our pair, we can see we have a clear double top pattern on the 4-hour time frame. We can see that we have a peak A, we have a trough B, we have a peak C. These levels are roughly the same height. So we can see we have a double top. We have the trough here at point B, and the pattern becomes live if and when this level around just underneath the 1.1700 level is broken. And if that level is broken to the downside, then we can reasonably expect the height of this pattern as a target. The target is roughly from 1.1700 up to 1.1900, so it's approximately 200 points to the downside. So that would make our target somewhere around the 1.1500 big key number. So that is a very simple run through of the double top and the double bottom pattern. I hope that you use it in your trading and that it becomes a useful technical tool alongside your fundamental analysis so that you can find ways to best take advantage of market moves in the coming days and weeks ahead. If you like this video, please do let me know, give me a thumbs up or a like, or let me know that it's good. And remember that I do each week on a Monday and a Wednesday for HYCM clients at 12:30 GMT time, which is currently 1:30 British Summer Time. I do run through a webinar where I go through latest market moves, latest technical setups, as well as fundamental analysis across the major currencies, indices and commodities. So if you would like to join me on that, please do join me for the latest market updates and market news as it breaks. Thank you very much for listening to this video, and I hope that you found it some use.